What's up, guys? Andrew back here with part 4 of our stock options series. This masterclass is all about teaching you fundamental analysis and how to use it for stock options. My goal here at Trading Options Daily is to give you all the tools you can trade yourself from your phone in 30 minutes a day or less and create your dream life. This is why I trade my stock options. I want to teach you this for free because I have nothing to sell you guys here, just all good information giving you value. So today, we were talking about technical analysis, which is just like the way you look at the chart to figure out different things, different patterns, different indicators, and how to kind of beef up the odds of getting good trades and making more money potentially with stock options. If you missed part 1, 2, or 3 in this series, the episode links are in the description for this video. So check them out if you want to do that. And also, make sure you subscribe and follow along and make sure you understand when part 5 and 6 come out and you don't miss a video of the series. Let's get into it. Technical analysis of stock options. So getting into session number 4, we're talking about how to chart and pick entry points in the chart to sell naked puts at. Once we know how the stock chart actually works, and we've kind of learned that new language, we're going to become kind of like Neo from the Matrix and be able to see code everywhere once you look. So it's not going to actually be that way, but it's going to be pretty close to that. And you're going to get more mature with it the second that you do it. So there's also a couple of indicators that you need to know on the chart. It's just basically the name for fancy squiggly lines that you can use and you're going to need to see to give you a better kind of idea and help you paint your own picture when it comes to picking out stock options that you like. And then you're going to maximize your returns, hopefully by putting these all together, combine it all into one soup bowl, and you're just a better trader overall because you understand these things as we go through it. So my goal for this session is to turn you into a charting wizard, going from a Gandalf the Grey in Lord of the Rings to Gandalf the White. You're coming back bigger, better, more powers. We want to tip the scales a bit further in your direction, give you a bit better chance of making winning trades. Again, if you missed sessions 1, 2, or 3, pick up this end card right there at the top. You guys go back and check those out if you want to go back and review the material. Getting into number 1, the basics of a stock chart. You have to understand the rules of the game if you want to play at this level. So on a stock chart, the price is found on the right-hand side there, that box right there. The dates are along the bottom, depending on the time that you have selected here, and you have the actual price of the stock, and you have the stock underlying stock kind of symbol ticker up here. AAPL is for Apple, of course, in the top left. And this data will change based on the kind of time preference you have, which is on the next slide here. And the blue line is the stock price right here. This is shown actually from the Interactive Brokers mobile app, the phone app that I use to trade. And all it's going to say here along the top is time. So this is 2 hours, 1 day, 2 day, 1 week, 1 month, 3 week, 3 month, 6 month, 1 year, 2 year, 5 year. And as you kind of select those through on the app, if you're using it, it will change the data displayed. Right now it's showing data for 3 months. If you went to 1 year, it would show you data for a full year. 2 hours, it would show you data for 2 hours. So it breaks down the time increments a little bit differently by the selections on the top. On the bottom, though, we have something very important. We talked about this in session number 1, and that is, we talked about a little bit of it. It's volume on the bottom. We have to have volume on there because we have to understand if there's a lot of buying and selling or just activity overall for the stock. We need to understand where the volume is and look for volume spikes specifically. We'll get into that a little bit later on in this kind of technical analysis seminar. So it's also really important to understand that there are 4 basic parts of a stock chart, okay? And you need to understand these to understand where the stock is likely to go. Not guaranteed, mind you, but just likely to go. And they are these 4. We have stage 1 here at the basing. And when a stock is basing, which means it's collecting, it's kind of thinking about what it wants to do next. Hopefully it's going to break to the upside, because if we're going to be investing in put options, with put options, selling them, we want the stock price to go up. And just generally, more people want the stock price to go up than go down. There's more positive people out there. Good for you guys being positive. Basing is where it's just kind of collecting and resting, let's say. Stage 2, we have this breakout, this advancing stage. So it goes from basing, it gains a little bit of momentum, and it kind of breaks out and starts to advance. And it goes up and it goes higher, and it's making newer highs all the time. It's got a nice kind of run here from 21.6 to 21.8. And then it kind of starts going to stage 3 where it kind of tops out, which means that basically when you're advancing for so long and people are kind of, they're buying stock or they're selling put options, and then they're going to make a lot of money, eventually it gets to a point where so many people have done that, they need to take some profit. And when you get that profit taking, the stock kind of slowly kind of starts to fade out. It's still going up, but then eventually it'll kind of pull backwards and it'll go into stage number 4, which is the declining stage. And this is just right here at the top. It's either people taking profit because they made a lot of money. It is some kind of bad news coming from the stock, maybe a bad earnings report or the CEO changes, something like that. And it ends up topping out at a point, and it goes back down into the decline. And after the decline, it goes back to, you guessed it, the basing stage eventually. As you can see here, the decline is over here on the right, but it also happened right here going down into stage one. And the variety and kind of length of these kind of movements it can differ greatly depending on the stock that you're looking at. But basically, these are the 4 stages you need to know and have an understanding of where the stock price is likely to go next. So as put sellers, we want the chart to be going up to the right. And if you see that, we want to kind of try and sell our puts on companies when they're in stage 1 or 2. Again, just to refresh, 1 or 2, we want to sell puts in 1 or in 2. We want to try to avoid selling puts at stage 3 when it's topping out or during stage 4 of the decline. We'd rather go in 1 and 2 because we make more money in stage 1 and 2. So also on the chart, you're going to need to know something called support and resistance. And these are very important because you have to understand these where the stock is likely not to move past. And resistance acts like a ceiling on the stock movement. Support is the floor. And both can be used for options trading. And I'll show you a quick diagram here. But the red lines in this chart are the ceilings, right? And the green lines are the floor. So when you're thinking of this, think of the red lines as if you're going to bounce a ball here. You bounce it off the floor, it would go up and hit the ceiling, but it wouldn't quite break through. Just like the stock price here, it wouldn't go through the floor because it's a hard surface. It can't go through. It also can't go through the ceiling, and it kind of pins balls through there for a little while. And then eventually it does break through. It takes a lot of momentum to do that. And then eventually you have a new kind of floor here where the old ceiling used to be. If you see that kind of roof and ceiling comes into a floor, and the new one is up there where you're not going to break through above, and they kind of go ping pong back and forth in between those there. So that is support and resistance. Those are important to know because you can identify areas where the stock is likely to move through or not move through. So our best case scenario, again, as option put sellers, naked puts here, baby, naked puts. We want to sell puts on an upward sloping stock when it pulls back down to a support level. What I mean by that? Well, in this scenario here, if you see this kind of stock price kind of pulling up and you see it hasn't bounced through this floor, we want to probably sell here. We might not know that yet because we haven't seen this kind of ceiling kind of be put in. But if we see that kind of dropping down and we see it here kind of stabling off, then we can know, okay, this is a really good floor. Let's kind of start selling puts around here. And then boom, hopefully the stock takes off like that and we're good to go. That's best case scenario. Lesson number 2, we're getting into the indicators that are going to help us give a better picture of where the stock might go. And there's 2 main ones we put on the chart to start, and they're called moving averages. And all moving averages they're just taking the past 50 days in this example and the 200 days, and they kind of plot all the data for those last days. The closing prices are averaged out, and that gets put on the chart in the form of a line. And we use these because traders and investors that are pros, like the big hedge fund guys and girls, they often use them themselves. So they're a very good idea and identifier of support and resistance on the chart, in addition to what we just saw with the red and green lines. So if we plot that 50-day moving average in the light blue and the 200-day in the light green, you will see them on the chart. They're labeled there as well. And those are what the charts will look like in Interactive Brokers on a 1-year chart. They're just showing you the average price for the past 50 days. And every day that moves forward in time, it chops off the 50th previous day, adds a new day to the total, and then kind of recalculates. Same thing for the 200, but there's 200 days of data. That's it. And how we use these is that we look for these kind of things called a golden cross. If we're going to see a gold cross, what happens is that the 50-day moving average crosses above the 200-day, and that is an extremely positive signal. So right here, it doesn't quite hit there, but you see this 50-day moving average, it almost kind of breaks up, and it currently is above the 200-day moving average, which is what you want to see. But when it actually does break out for the first time, that is an extremely bullish signal that there's a lot of growth potential in the stock. What we don't want to do, though, we want to trade very lightly or not at all, or give ourselves tons of room to the downside if we see what's called a death cross. And a death cross is when the 50-day moving average goes underneath the 200-day, and that is an extremely negative signal or very bearish, as the market will tell you. So if we saw the 50-day, it almost did here, kind of flattened out, and the 200 kind of popped up. If the 50-day kept on kind of dropping down, that means the stock price would have gone down below the 200-day as well. And if you see the 50 go below the 200, that is a very bad signal for the market, for the stock, for everything. It just shows a lot of weakness in the stock and in the market. So keep those 2 in mind. Those are big things to look at right away when you look at your chart for the first time in the morning, whenever you trade. Golden cross, death cross, 50-day, 200-day moving averages. Another indicator we want to use is a Bollinger Band. And these are significantly used by a lot of traders out there. And they're for support and resistance. And they're made up of two bands. There's one in the high limit and one in the low limit. And then sometimes you also get a moving average tucked in the middle of the two, which can be the 20-day moving average, but you can turn that on or off on your chart if you want to. I prefer to leave it on just to have it on, but they're calculated using what's called standard deviations for a number of given days. And if you remember standard deviation, you probably heard about it a little bit back in like grade 9 or grade 10 math class, freshman or sophomore math class. We'll get into it. We'll explain it real nice right here for you so it's easy to understand. On this chart, you see BB up is green. That's the upper Bollinger Band. BB low is yellow, which is the lower Bollinger Band right there. And it's giving you standard deviations right now of 2. So what that means then is if we take the standard deviation and look at that, this is probably a chart you might have seen before in high school again. What it's saying here, this isn't just for stocks, this is like for standard deviations in anything, right? When you have 2 standard deviations, okay, that's everything inside this kind of red square here, okay? What it's telling us is that 34% is just above 0 to 1 standard deviation. 34% of data is from 0 to -1 standard deviations. And then there's an extra 13.6 and 13% between +1 to 2 standard deviation and -1 to -2 standard deviation. And what that actually means, why this actually matters for you, is that 95% of the data in anything that uses standard deviation to calculate it is contained in between 2 standard deviations, -2 and +2. So all the data there, 95% of the data is there. So what we're going to do to make this really easy, right? Think of this as the upper Bollinger Band right here on the chart. Think of that as the lower Bollinger Band. And what we're actually going to do now is just take it and flip it on its side and throw it onto the chart. So this is the same graphic we just saw right here on the previous page, right? We just flipped it on to the right. And now we're seeing, okay, -2, +2. Right now, this is like the lower band. This is the upper band right now, okay? And what's going on is that 95% of the data on the stock chart now is going to be in between the upper band and the lower band. So in between these 2 bands here, the stock price is going to be in between those 2 95% of the time. That's what it's telling us. That's how math can be fun and useful to make you guys money, hopefully, right? So what it's telling us is that if we know where the price is going to be 95% of the time, we have an idea of where the price won't be the other 5% of the time. Sorry about that. Going back just one slide. If 95% of the time it's between the green and yellow line, that means 5% of the time it's going to be outside the line. So this gives us opportunity because if we see a part of the stock where it actually is outside that line, we have a very strong conviction that it's going to break back inside the line. So in this case, if it broke higher than the upper band, well, we know that it's probably going to go back lower. Like, where do you think it's going to go, right? It's probably going to go back lower because 5% of the time it's outside the band, 95% of the time it's inside. So this is a 5%er right here. It's an outlier. It's probably coming back down. And you got to tell yourself, like, is this a good time to sell a put, in your opinion? Drop a comment in the section down there for the video. Let me know. And I'll give you guys the answer here in a second. But if you see this right here, like, that's an outlier. That's a potential. And the answer to the question, you guys put in the comments there, but the answer to the question is it's not a good time to sell a put because the stock price is declining because it's outside here. It broke above higher. It's probably going to come back down. We always want to sell puts when stock's moving upwards. So it's probably not the best time to sell a put if you're doing it when it's breaking to the upside. If it breaks to the downside, oh yeah, that's kind of a better time to sell a put because it's likely to come back up. Another one we're going to look at here is relative strength index. We're going to put them all together at the end. But RSI, as it's known, is a momentum indicator, and it tells us whether the stock is overbought, so it's likely to drop, or if it's oversold and it's likely to break out. And it's shown as a line on the bottom of the chart and can go from 0 to 100, just like Drake. Just kidding. But the RSI here is shown in blue, and it's for a 20-day period right now. And what it is telling you, again, if it is above certain levels, it is overbought. If it is below certain levels, it is oversold. And on this chart here for the RSI, it looks like this in terms of overbought and oversold. If it is above 70, it is overbought, meaning it's probably going to pull back. If it's below 30, it's oversold. That means that it's likely to kind of pick up momentum soon. There's been so much selling, so much downward pressure that it's likely to pick up unless the stock is like in a crazy kind of tailspin. And these are generalities, they're not kind of guaranteed. None of these kind of technical analysis indicators are guarantees, but they help tilt the odds in your favor of what could happen. So if we looked at an RSI, we see it crossing above 50 up to the right, that's considered a bullish signal. And if it's trending down to the left or down to the right, it is declared a kind of bearish signal if it's going down to the right. That's how we kind of interpret RSI. And then just a quick note, every single kind of stock itself will have its own RSI pattern. So some stocks may have a low RSI value, and that might be normal for it. And some stocks may have a very high RSI where it's above 70 consistently all the time. And that's just a very volatile or very kind of popular stock that's trending in a certain direction. So you just have to understand that RSI, it's there for the market. It's also there for each individual stock. And when you have a stock that you like, make sure you understand the RSI for that kind of specific stock relative to the market as well. Now, lesson number 3, we're going to put it all together. We're going to maximize some gains, hopefully, and we're going to just combine what you've been shown. So we know moving averages now. We're going to look at our charts in the morning or wherever we're going to trade. We want to check for support. We want to check for resistance levels. We want to see the gold or death cross. We want to stay away from the death cross. We want to go ahead. If it's a gold cross, that's great. That's great to see. We want to look at Bollinger Bands as well. We want to make sure that if it's approaching the upper band or if it's approaching the lower band, think about some outliers that could happen and understand where you're going to make the most money, which is always if it's breaking lower, it's probably going to pop back up. If it's breaking higher, that's good, but it's probably going to come back down. So take a second, just think about maybe waiting a couple of days before you sell your put. And RSI, overbought or oversold? Is it bullish? Is it bearish? Is it breaking out? Where's it headed? You combine all 3 of these things and you get a chart that looks something like this. So in interactive brokers, you can actually see everything by just clicking your thumb in the chart and holding. And those legend lines here, that kind of crosshair will pop up. And it'll also give you the legend on the left. And it's important to understand this because every line, maybe it can change color within interactive brokers if you go in and out of the app. So the lines aren't always the same color, which is kind of a flaw in the system, but you have to understand which lines are which. And here you see you have a Bollinger Band. Upward is this kind of purple line. Lower is the orange line. You have the 50-day moving average, which is yellow. 200-day is pink here at the bottom, and you have RSI, which is like a white color at the bottom at 46. So it actually tells you the kind of the numbers for all these things as well, and also have your Apple here and your stock price as well. So everything's on the chart now, and this is a very kind of basic kind of chart. If you have a couple indicators on this, what it's going to look like, and you can see everything here. It's kind of easy to kind of pick out different data, and you just have to go through and kind of get familiar with this kind of layout. And if you want to take it one step further, you can go ahead and look at candlestick charts. And what I use for candlesticks is just they paint a little bit bigger picture from day to day kind of movement for the stock price, and they give more data than line charts. So there's a battle going on every single day between the buyers and sellers, and candlesticks give you a better idea of what that battle is doing. If you want to get a nice quick reference, I do have an ebook on candlesticks, how to read them as a beginner. I will put that in the show notes for this. I'll put that in the description for this video as well. You guys can go pick up a copy of that if you choose to do so. But yeah, that's how it kind of looks. So what you have to remember though is when you're doing this, you don't want to be like paralyzed by fear. And it's not like it's going to be every single indicator is going to hit positively. And so if you're looking and waiting for that, it's pretty hard to get there. And it doesn't mean that it's a bad time to trade, but we want to kind of like look and just figure out if a couple of these indicators are working to our advantage. If they are, we can see setups, we understand where the data is going, where it's likely to go, and we can kind of execute a trade from that perspective. That's how you kind of put this all together and you go from there. So it's super important to understand that when you have technical analysis, that is only one half of the pie. What you need to do is actually combine technical analysis in one hand and put it together with fundamental analysis when you're picking your companies. That way you pick great companies with fundamentals and you have the technical know-how to trade when you're supposed to. So in order to do that, make sure you check out part 5 of this series coming up soon in the video right here.